Just how good is a good year for stocks? And just how bad is a bad year? The answer to the good part is really, really good. Sadly, the answer to the bad part is really, really bad. You might want to sit down for this next part. Between the years 1926 and 2012, the best year return was in 1933, which checked in at almost 58%. The worst one-year return was in 1931, a loss of almost half, over 44.4%. Now, don't make the mistake of thinking that the downside is less damaging than the upside. If you start with $100 and suffer a 50% loss, then you have $50. It takes a gain of about 100% to make up for that 50% loss. What these numbers tell us is that the worst year and the best year are reasonably similar in the sense that they pretty much cancel each other out. Looking at historical rates of return over different time horizons tends to make people think that the longer you stay invested, then the safer you'll be. For example, from 1926 to 2012, one-year returns vary from a loss of about 44% to a gain of about 58%. For two-year returns, that range narrows to a loss of about 37% to a gain of about 38%. For 10 years, the range is from about a 2% loss to a gain of about 19%. For 50 years, the range is from a gain of about 7.4% to a gain of just over 13%. For 75 years, you can say that the rate of return is right around 10%, whether you have a good 75 years or a bad 75 years. The range is only from 9.4% to 11.7%. Lots of people interpret this as showing that the longer you stay in the market, the safer you'll be. Many of you have seen this idea promoted before, and if you haven't, then I'd bet you will soon. But the argument is simply wrong. The longer you stay in the market, the more risk you bear, not less. Yes, the range of potential rates of return does narrow over time, but the range of potential payoffs in dollars doesn't. The longer you're in the market, the bigger the potential losses and gains in dollar terms. And you buy things with dollars, not rates of return. Does it sound strange that even as the rates of return tend to even out over time, your dollar values don't? Most people think it does, but that's just the way it works. The intuition is that as the rates converge with time, you may miss by less each period, but you miss for a longer time period. Let's use an analogy that's more familiar to us. Suppose that you and your friend Lisa each take a car and set out on a long road trip. Lisa averages 60 miles per hour for the first hour, but you only average 50. After the first hour, you're 10 miles behind. Now suppose that during the second hour, both you and Lisa average 60 miles per hour. Lisa is still averaging 60 miles per hour, and now that you've covered another 60 miles to go with your previous 50, you've pulled your average up to 55. But you're still 10 miles behind Lisa. Think of it this way. Instead of falling 10 miles behind in 1 hour, you fell behind by an average of 5 miles per hour for 2 hours. You're in the same place relative to Lisa, either way you think of it. If you had averaged 58 miles per hour during the second hour instead of 60, then you would have lost another 2 miles and been 12 miles behind instead of 10. But the difference between your average speed and Lisa's average speed would still have narrowed, even though you lost more ground. Instead of 60 miles per hour for Lisa and 50 miles per hour for you after 1 hour, it'd be 60 for Lisa and 54 for you. You gain in terms of average speeds, but you lose in terms of miles because you lost ground for 2 hours instead of just 1. It's the same for rates of return. Suppose that the expected return on stocks averages 10% per year, but in your first year you earn 0. That's bad. You're 10% below the average annual